Hello, everybody, and welcome to this week's True Potential Do More With Your Money podcast. This is episode 29. And don't forget, if you have missed any of the previous 28, you can binge watch till your heart's content. Just head over to our YouTube channel. They're all on there, and you can podcast till you drop. Today, we're joined by Jeff Casson, Chris Leyland, and George Bell. Hello, gents. How are you doing?
Very well. How are you?
Good, thank you.
Yeah, all very good. A bit hot, actually. Sweating a bit today. It seems to be red hot across most of the country today. So I'm absolutely boiling hot. And I don't know if do you like my virtual braces that I've got on today?
Love them.
They're quite
Fantastic.
Cool. In the spirit, Chris, of this new virtual world that we've all been living in for the last 4 and a bit months, where this is now how we all interact. I felt virtual braces was the latest invention. So if I just do this, you see, there's a bit of satellite delay on them. They don't quite keep up with me, but they're pretty good. The real answer, of course, is I'm sat in front of a blind where the sun is beating through, and there are 2 little gaps down the blinds. So these braces will just move slightly off camera through the course of the podcast. Of course, that makes no sense whatsoever to anybody who's listening and not watching this.
The illusion, Peter.
Absolutely. Well, speaking of illusions and things like that, while we're talking about the YouTube channel, everybody, it's worth having a good look at that because there's a couple of little things I'd like to point you the way of. And one, of course, Jeff, involves you. Viewers can get we see a lot of you, by the way, Jeff. We see you every morning on Morning Markets. You're a regular on the podcast. And we kind of get this view of you of what's behind. But what's brilliant about a new feature on the YouTube channel is we get to see the other side of Jeff, literally looking the other way and what you get up to when you're not talking to us about markets. So tell us just briefly before we get into the main podcast. For our viewers and listeners, you can head on to there. We can just get a bit more of a feel of what it's been like for you working from home and in this slightly odd environment that we're all in. But just tell our viewers a little bit about what you've recorded on that video and what they'd be in for.
Well, maybe in for a shock, Peter, depending on how they think about things. But I suppose what did I try to give a little bit of an insight into what happens in a daily basis when we're thinking about markets, how we all work as a team, and also a bit about what I like to do in my downtime. So it probably didn't surprise anybody that there's a lot of stats in it. So it's all about cycling. What speed can you do? What average speed can you do? What cadence can you do? Etc. Etc. So that was where I got to in that. So I did enjoy doing it actually. Although it was quite difficult to get all of the video shot, but it was a good thing to do. So if you do want to enjoy it, just go on to the channel and have a look.
It's 10 minutes well worth watching, everybody, to see the other side of Jeff. You seem to have a golf course out the front as well, which I don't know. I wondered if that's how you spend a bit of your time out on the golf course when you're not looking at how the US markets and the FTSE's doing. One other thing that I picked up, Jeff, that I must bring up. There's a piece halfway through the video where you stood in front of your bookcase, and it's a very impressive and expansive bookcase, by the way, as well. So there's a lot of good stuff in there. But what is hedge hogging?
I did notice that earlier, and I thought I should have removed that because I thought these sort of questions would come as a result of that. So we'll pass on that one, if you will, and then we can come back to that as another book review session for another session that we do.
Okay, well, the mind boggles, and it sounds like Jeff. It sounds like a prickly topic. I'll say no more. One other thing I wanted to mention, by the way, on the YouTube is in your video you talk about how you've gone cycling, and a lot of people, of course, are doing that, and it just reminded me of the True Potential Sports Day that a lot of the staff who work at True Potential took part in and managed to raise an awful lot of money. I think well over £3,000, £3,456 to be precise, for a great charity called the Sick Children's Trust. And we had a lot of fun compiling that video and a lot of people taking part in it. But the real, I suppose, output is there's a really good cause that's going to benefit hugely at the end of that as well. So again, another one to go and have a look at on the YouTube channel and see how we had a lot of fun raising a lot of money for a great cause. So lots to have a look at over there. Right, question. Who here is on TikTok?
Definitely not me.
No.
Can anybody explain?
The funny thing about that, Peter, is I had to, being the oldest person in the team, I had to ask everybody there the other day, what is it and what do you actually do on it? Because I have no idea.
Yeah. Are you any the wiser?
I'm a little bit wiser, but I think George has got
the
best insight into this.
Come on, George, fill us in. What is TikTok?
TikTok. So I'm not on there. So if anybody's trying to search George Bell on TikTok, I'm not there. But I do know what it is. I'm very familiar with it. It's basically a Chinese video sharing social network service offered by a company called ByteDance. And basically what it is you can have short dance videos, you can have lip sync, you can have comedy, you can have talent videos. So it's the perfect sort of platform for the investment team, I think, to move into.
I think you've set yourself up there, George. I think you're going to have to do that now. Well, George, no doubt we'll come on and talk about TikTok. The reason, of course, I bring it up is it's been a lot in the news over the last few days with Donald Trump's intervention and just generally what's happening around that company. And I suppose it throws up some broader questions as well that we'll touch on. But before we get into that, George, while you're on in full flow, what's been happening in the markets over the last week? Just kind of give us a flavour since the last podcast of what's been happening.
Yeah, sure. I say this every time, Peter. It's been another busy week, but overall a positive week for equity markets. It's reporting season in the US, in Europe and the UK, which really provides an opportunity for analysts, for traders and investors to review earnings reports and some companies to provide some forecasts about how they expect companies to perform in the short term and in the longer term as well there. So there's been some examples of pressure from a number of companies in, say, the energy space, in certain areas of advertising, but many are surprising to the upside. And why do I say that? It's because we've discussed in these sessions the challenges which analysts have had with forecasting the impact of COVID-19 on the economy, but also on business as well. So therefore, we're pleasantly surprised by certain areas of the guidance provided by companies out there. In the UK, I think it's been interesting to see a number of companies move forward with dividend payment plans and give an indication as to how they foresee the future use of cash flow. And it will certainly make for some interesting discussions, which we have coming up with our managers over the next few days. But I think what's interesting in the guidance is another area which we've been discussing, and that's the acceleration of a number of trends. And typically we've been talking about these in the context of the consumer and spending habits, but there's also an acceleration of many business plans. So whether it's embracing technology more, or whether it's companies like BP looking to use cash from their traditional sources of the business in more lower carbon areas. I think in credit markets, specifically sovereign, which is government bonds, we've seen yields continue to come in lower, negatively in many areas, which inversely means an increase in the price of the bond and at a higher base, but we're seeing a similar direction across the corporate bond space there as well. In gold, we hit the $2,000 per ounce mark, which the market's been sort of bouncing around that level for a couple of weeks now, but this week we broke through after what was an incredible July for the gold spot price. And for our audience wondering why there's been a sudden rush for the demand in gold, don't get your hopes up that you're going to have jewelry on the way. It's traditionally viewed in a portfolio construction as a more defensive allocation, which speaks to a lot of the development which we've seen around the economic landscape and debt levels overall. But we've also seen silver improving over the week in terms of its spot price. We think of this within many of our managers in with other precious metals within a sort of precious metals basket, which I know Chris has put out a number of videos on chart of the week around that. Silver typically has more industrial uses, so it's been benefiting from the reopening of economies as measured by a lot of the high frequency data, which looks at orders, it looks at things like hours worked, footfall, travel, which is really what's needed at this point in time, I think, Peter, for key decision taking. Because the data is moving so fast, you've got to have an awareness of what's happening on the ground there. But linked into this, I think we also had PMI data, so from IHS PMI, which is really a forward-looking leading indicator, which is giving some sense of direction of trends in both manufacturing and in service sectors. So we had reports showing improvement in the UK, in Europe, and in the US, where we also saw a stabilization of the service sector, which is vital for the US economy overall. And various data points coming from China, which I'm sure we'll catch up on. But I think another important point, which I was just catching up on before this session, was just around the employment data in the US. So we know employment data is crucial for the recovery. We had the ADP jobs report from the US, which showed that the pace of jobs growth cooled through July with some localized pickups in COVID-19 cases, whilst the aggregate number of jobless claims increased to the week ending the 1st of August. It suggested the rate of increase had moderated from that of the week prior. So some 249,000 fewer people claiming welfare, but the welfare package is still supporting around 16.1 million Americans, which is an important statistic in the development of the second stimulus package discussions, which are ongoing at present. And I think finally, just something which is noteworthy is the Bank of England Monetary Policy Committee meeting, which was interesting from a number of aspects. The discussion around the shape of the recovery, which they foresee developing on the comments made in their last meeting, but overall, no change in the interest rates. Interest rates will remain that being base rate at 0.1%, with no appetite to hike in the near term, and voting unanimously to keep the asset purchase target. So that's bond purchase, the bond purchase program, which they have at 745 billion, which is there to sort of provide the liquidity to the credit markets. But they can start to moderate the pace of the purchasing, keeping some capacity, along with a number of other tools which have been discussed in the headlines in the toolbox for now. So another busy week in markets, another interesting one, and one which we look forward to discussing in more detail with our managers as we move on.
Great, thank you, George. I'll come to Jeff in a moment just to kind of expand a bit on that Bank of England announcement that we've seen this week, and maybe just some considerations around confidence out there in the business community and how that might feed its way through, and also thinking about some of the changes coming up in terms of businesses now having to contribute towards the furlough scheme and that coming to an end. We've also seen some negative job news, if you like, in the UK in the last week or so. So maybe we'll touch on a bit of that with Jeff in a moment. Chris, I wanted to ask you, George picked up quite well there around this idea of gold, and I think it's one of those things that from a client point of view, you might sort of wonder where gold sits in ordinary times within an investment, within, say, one of our portfolios. I mean, is gold something which is more of a safe haven in turbulent times where we would look at in that kind of environment, or does it feature ordinarily in, say, a portfolio or an investment, just maybe to a lesser extent? Give us a sort of sense of the importance of gold and silver, as well as George was saying, from a client's perspective.
Yeah, sure. So if we think about the true potential portfolio proposition, we have holdings within gold, within silver, and within platinum. And it's quite interesting, you were saying, is it a kind of hedge against maybe more negative equity markets? And what you've seen actually at the start of this year, so February and March time, where the coronavirus took hold and equity markets fell, you saw that gold actually rallied, so they made money. But I think what's quite interesting is actually, even when equity markets have rebounded, gold has shown a good, strong performance. George mentioned that it had gone through a new high, it had gone over $2,000. And basically, there's one sort of big reason for that, and that is really around stimulus. So obviously, what we've seen is governments, central banks enacting huge levels of stimulus. And what could that mean in the future? Well, that could potentially mean inflation at some point further down the line. So what you have seen is some investors look to gold as a way to protect against that. And I think the other reason as well is, if you look at the government bond market, George touched on the fact that government bonds, sovereign bonds, are either yielding very low levels or actually in some areas are on negative yields right now. And what you've seen is investors look towards gold as a way to provide diversification around equity markets overall. So I think if we look at the portfolios, you've got gold, which I guess is the kind of traditional diversifier, and silver and platinum we've got in there as well. Silver's got maybe a little bit more of an industrial usage, so a little bit more sensitive to the world economy opening up overall. But from my perspective, when you look at the numbers this year for precious metals, the numbers are fantastic.
And Chris, if we go back, say, a year ago, would gold have featured then, or in any event? Is it more the case that it features more heavily in these kind of times when there's a bit more volatility around? Is it never present, just to a lower extent, or is it not something that we would normally consider, or that you would normally consider in dare I say ordinary times, if there is such a thing?
Yeah, I think the reality is this year I've been quite pleased in the sense that we've had a larger weighting towards precious metals overall. I think the problem with precious metals is kind of from a traditional investment perspective, they're very difficult to value. So there's no cash flow there, so you can't value them on a kind of traditional discounted cash flow basis. So what you find is either fund managers love gold and think it's great and will always have it at some level within their multi-asset funds, or actually there's some managers there who say, do you know what, I don't want this. I don't understand how the price moves. I struggle to value it. Therefore, I don't want it within the multi-asset environment. But from our perspective, we would have had gold last year. We did have an addition of silver and platinum come through over that period of time, and the gold allocation has also increased as well within the portfolio. So I'm pleased. I'm pleased that we've had that in there, and I'm pleased that we've had a larger allocation, and I'm also pleased that we've had silver and platinum as well.
It's really interesting to get a feel for it. Go on,
Peter, on that. It's just historically who have been big buyers of gold. It's been traditional central banks. So central banks have used gold, and they have over the past number of years been increasing their overall holdings of gold. And as Chris says, it's broadened out, and others are seeing the role that gold can provide as a diversifier in portfolios. So that is, I suppose, a little bit of that's changed. The other thing, that way people take exposure to gold and how we've have some of that within the true potential portfolios is through the gold miners, who benefit as well from the movement in the price. So we've seen quite a significant performance come through from the miners themselves, because they're quasi geared to an improvement in the gold price because of the operating leverage in their business models to the price of the commodity that they're selling as well.
Yeah, fascinating. You mentioned central banks there, Jeff. Probably a good time just get your perspective really on today, the Bank of England, as George was saying, with its announcement. And if for anybody reading it in their morning papers or they're watching it on the evening news over the next few days, what's your major takeaways from what was announced? Was there anything particularly notable or unexpected? And I guess the second part to that question is, what difference do you think that'll make to, say, a true potential client? Is there anything that would feed through or that would be notable for them?
I think there's a couple of things to think about in that regard. And I suppose when you take a look at the monetary policy report that came out this morning and all of the sort of supplementary information that's with it, the Bank of England produced these charts called fan charts, which allow you to see sort of their central level of where they think activity will be it GDP, unemployment, etc. And then they put bands around them, which are their sort of confidence levels. And they're very wide fans, shall we say. They'll create quite a big draft when you move them at this point in time. So what does that speak to? It speaks to something that George was alluding to there, just the uncertainty that there still is in trying to forecast, and it maybe feeds into one of your earlier comments as well, Peter, around what business is doing and how businesses are thinking about the furlough scheme and what does that mean for unemployment trends as we go through the year. I think what the bank that I find interesting, they dedicated quite a large section of the report to negative interest rates. And so if we think back to what's been happening in the UK gilt market over the past number of weeks, we've seen gilt yields being pushed lower, as George has mentioned, but at the out to sort of 7-8 year maturity levels, the yield curve was negative in the UK, which is quite an interesting dynamic for the Bank of England to think about. So the market probably trying to force them into that stance. What did we see today? We see that they've come out, they've very neatly set out the rationale for it, how they think about it, but now's not the time, given the the amount of stimulus that's already in the economy and the fact that they believe through the QE program where they could do more, and also through forward guidance in terms of how they're thinking about the shape of interest rates going forward, that they see those as better ways of providing information to the market about how they see rates evolving in the future. So I thought that was quite interesting that they've come out and addressed that head on, which was important to do. I think the other thing that we can take from it is just the challenges that they're facing. There's been quite a change in some of their analysis from where it only was 3 months ago, and that's to be expected because everything is moving relatively quickly around people returning to work, the consumption patterns that we're seeing, and the investment plans that we're seeing from some businesses, as George alluded to there. You've got those that are moving forward with what they're doing. We've got others that are holding back. So a very difficult policy mix for them to navigate our way through. But lots in the document that gives us pause for thought, pause for consideration. How does that feed into the TPP portfolios? Well, through the actions that we're taking in terms of the exposure that we have to either gilt markets, to UK equity markets, the exposure that we have to sterling as well, because that has been one of the real interesting moves that we've seen over the past month, I would say. Now, my own sort of view is that a lot of that is just down to dollar weakness. Not a lot of it's attributable to what's happening in the UK economy, but interesting to see sterling have another little bit of a pop today as well when that report came out. So lots of interesting things in it, things for us to think about from a TPP perspective, and things to then address with some of the underlying managers as well.
Yeah. Actually, one interesting little note that I picked up earlier was just in terms of how the government's performing in this country. And we know if you're running a private business, or if, even as a consumer, when to wear a mask, when not to, are the pubs going to be open, are they going to shut so the schools can open? There's a lot of messages coming out of government as well, which appear to be either contradictory or just the public, and businesses might sort of you might expect the government of the day to be polling quite poorly at the moment, just given the backdrop against everything. But actually, there was a poll came out earlier today, an Ipsos and Mori poll, pretty consistent with other polls that have come out from the major pollers over the last few weeks and months. But the Boris Johnson's government has an 8-point lead over the Labour Party, which is quite astonishing, really, to have a gap that big at this stage with everything else that's going on. So it just made me think ahead to next month now, when I think the Chancellor is going to be putting forward a new bill, a recovery bill, a spending round review, basically. We might see extensions to things like furlough possibly, or other support for businesses, because, as I say, eat out to help out, dare I say it. I don't know if anybody's done that this week, but I know these things cost a fortune, and you guys are well placed to talk about the economics of it. But from the politics of it, if you're polling 8 points ahead in the midst of this, after the few months that we've had, and we know the UK's position on coronavirus and how it's been handled here and all the rest of it, I just thought that was, that I assume that is feeding through into their thinking, and maybe some of the decisions that are being taken. But on Eat Out to Help Out, has anybody done that this week?
Not yet. I thought about it, and I actually looked at a local restaurant, and it was for Tuesday night, and the restaurant was full. So other people must be doing it other than me. I just don't think I've got there in time.
You've got the rest of August, Chris. Jeff?
I have, true.
I haven't yet. So, like Chris, I've got some time off next week, so I'll maybe try and use that to try the scheme and see how it works.
George, you've got a figure to keep.
You've used it, George, haven't you?
George, haven't you? So surely you've not been out for a half-price burger.
I haven't been out yet. Never mind Eat Out to Help Out. I haven't been out at all. But yeah, I mean, I'm sure I will over the coming weeks. I know Newcastle's been pretty busy, which it's nice to see. It's nice to see people starting to get used to going out in a COVID-safe manner. And it's good to get some sort of sense of normality. And the stimulus packages, they'll be debated in the form they take. So the Eat Out to Help oh, is that enough? Is that is the scheme supportive enough for the consumer to sort of incentivize that demand? I think it's all just a gesture, a direction of travel, or something to get people to take that first step and to recognize, a new way of potentially operating, at least for the short-term foreseeable future.
So I'm quite surprised, Peter, at that poll, just given everything you read in the paper, that is the case that we've come through with them, that magnitude of a lead. And if you think back to just the beginning of August there last week, when they're trying to urge all businesses to get back to work, but when you look at some of the surveys that are there, you look at the City of London, it seems to have very little has changed. There are very few businesses appear to be following that. So I'm surprised that there's that magnitude of a lead at this point in time.
I was, Jeff, it's why it sort of jumped out. I've just got the figures here. Boris Johnson and the Conservative Party on 45% against 37 point for the Labour Party. So, that's a big lead at this stage. And actually it's comparing to a week ago. And it's a 2-point increase. So not even it's two things. One is the scale of the difference, but actually the Conservatives taking a bigger lead, adding percentages on. So maybe, who knows, maybe it is eat out to help out. I don't know. Let's just turn our attention then to the other side of the Atlantic and talk about, the polling that's going on over there. And I noticed that Donald Trump is trailing Joe Biden by, a few percent over there in the US election. Seems to me, looking at where he's trailing, it seems to be the states where he had big leads over Hillary Clinton 4 years ago. So places like Arizona and Ohio and North Carolina, where there were big Trump leads last time round, really trailing there this time round. But of course, what we see with Donald Trump, and we saw this 4 years ago with walls, Mexican walls, and so on and so forth, is he needs to have an enemy, and especially on the campaign trail. That goes on rocket boosters. And we've seen a bit of that this week we've seen it a lot over the last few months with China. But particularly this week, he had TikTok, which is why I mentioned it at the start of the podcast in his sights. So Chris, just for anybody who maybe missed that, what was his beef, or what's he been saying this week about TikTok? Why did that come in the news this week over in the States?
Yeah, sure. So I'm in the same camp as George. Unfortunately, I haven't had a chance to use TikTok myself. But what I would say is Microsoft
that you know of, Chris. That you know of.
Yeah. Microsoft are looking to acquire the US, Canadian, Australian, and New Zealand operations of TikTok. Obviously, Donald Trump has decided to get involved in that. From his perspective, he's looking at it, or he's saying he's looking at it from a national security perspective, and he obviously doesn't want any US data to get into the hands of the Chinese. He came out and said that he wanted a cut of the deal. So he wanted the US Treasury to receive a payment around the deal, which is pretty crazy, in my opinion. He said that the deal needs to complete by, I think it's either September the 15th or September the 16th. But for me, I think it's interesting. I think for Microsoft, it could be quite acquisitive. If you think about why they're doing it, the reality is that Microsoft, they missed out on everything that happened in respect of the mobile revolution. And, in some ways they're catching up now, and they've got a good way that they can access lots of young people who are looking to post videos of dancing and singing, but also give them all their data as well. So the big thing that this is about is data. So what happens is Microsoft want that data. They can then use that data to develop new products, to sell products to the people that use TikTok. And there's some nervousness there, I guess, from the US around the potential for China to get hold of some of that data overall. But for me, I think it's fascinating.
Chris, I think how unusual. Sorry, George. I was going to say, how unusual is it for governments of any country to especially Western economies, to be taking cuts of business deals? I mean, is it unheard of, or does it happen? George, tell us. Have you seen it before, George?
This is from the chap who wrote the Art of the Deal, Peter. So you've got to have that in the back of your mind when you think about what Donald Trump's looking at here. But I do think the concept of Microsoft looking at TikTok is a really interesting one. Chris mentioned a number of the points. You've also got to remember the other sides of the Microsoft business, so areas such as Xbox, where they can use that large revenue, the large advertising stream, not only as a source of revenue, but as a way of bouncing to other parts of their business. And in terms of ad revenue, a lot of the US market at present is captured by Google and YouTube, Amazon and Facebook. So it could be a foothold for TikTok or Microsoft to step in there through TikTok. But in terms of looking at the deal and gauging a valuation, I think that's been an interesting discussion. And the way in which people are articulating a potential valuation, I think it would be interesting to see how that's going to evolve, and then also what the Treasury's cutout of that is.
And Jeff, that normally I would expect that states, governments saying they're going to intervene and take cuts of deals would scare markets and scare corporates, and just not be the kind of news that they would want to hear. And you probably see that reflected on the markets. But US markets have been doing really, really well. Obviously, Donald Trump is trying to drive a wedge between himself and Joe Biden, and saying that Wall Street, the S&P doing really well, and he's clearly trying to take a bit of credit for that. I guess a little bit of our own fact check type thing. Are markets in the US doing really well? If they are, how much of that do you think is due to anything at all that Donald Trump is doing? And is it basically the companies on those indices across the board, or are there a few outliers who are really shooting ahead, and that's what are they leading the pack, or is it across the piece?
Yeah, I think there's a lot in that question, and we could spend a lot of time trying to answer all of them. I think if we take a step back and we think about an election year in the US, what is the economy is really important. Ultimately, as we've seen in previous elections, if the economy is doing well, the incumbent tends to get re-elected. One would probably argue at this point in time the economy is being challenged. If we just think about the numbers that George mentioned there at the start, in terms of the overall number of jobs that have been lost, that is a difficult electoral backdrop for an incumbent president to be dealing with. Albeit, yes, it has improved from sort of 18.7, 18.6 million at the height of the challenge, but it's still 16 million people. And if we try and put that into context, there's been about 14.3 million jobs that have been lost in the US in this COVID situation that we're trying to deal with. So that's the backdrop that he's dealing with. And I think you're right, Peter, in the sense that he wants to deflect that somehow. It's easy to try and deflect it onto what Biden's doing, but Biden hasn't really said very much yet, which I find quite interesting from the presumptive Democratic nominee. The other side of it, as you touch on, the market is doing well. So people will be seeing that in their 401k plans that US citizens have. But then again, it's a relatively narrow part of the market that's doing well. And a large proportion of that is being driven by Facebook, Apple, Amazon, Netflix, Google, and Microsoft as well. So those sort of six stocks have been very important to the overall performance of the S&P, and indeed they account for some 27% of the S&P 500. So I think that's one of the things that when we as a team are talking about and discussing the US, you have to try and separate what's happening in the economy versus what's happening in the stock market, because at times those two things can be very disconnected, and that's important for us to think about as a team, think about when we're looking at our true potential portfolios, and also in the discussions that we're having with the managers as well.
And Jeff, would those, I think we call them the Fangs in your investment sort of terminology, would they normally be the companies that are far out ahead and really leading the pack, or is that being heightened because of the fact that people are working from home, so they're on perhaps things like, well, Netflix perhaps more, and maybe Facebook? Has that really kicked them on, or are they just always out there?
Well, I suppose it's been a thematic then in the market we've been dealing with and thinking about for probably the past number of years, where these technology platform businesses have been able to continue to evolve, invest into their businesses, and that investment has allowed them to continue to grow successfully. And in that regard, they have been taking incremental market share from other providers. Now, they've either been doing that through natural growth or through acquisition. So they have got bigger. I think what we have seen is that even if we look at the UK market, for example, and think about how much retail sales have moved online, these platforms have been some of the platforms that have facilitated that. We think about us all working from home, Netflix subscriptions, downloading from Amazon, it's all increased. So incrementally, their businesses have been continuing to grow. And I think that's the distinction, that whilst the past number of years, economic growth has been relatively anemic, these businesses and businesses like them across the world have been able to grow their earnings significantly more than the market. And as such, part of the re-rating that they've seen from a valuation perspective is wholly justified, because they've been getting a bigger part of the pie. And that's just if we look in the US, but then if we go to Asia and you look at what Alibaba has been doing, we look at what Tencent has been doing, we look at what ByteDance's Chinese business has been doing as well. It's like a global issue where we're seeing platform businesses continue to accelerate the growth that they've been delivering because they've been able to reinvest in themselves.
Fascinating. So, I mean, genuinely, more people in the UK, getting Netflix because we're at home and you're not going to the cinema and what have you. If you've got a true potential portfolio, potentially some of that activity is feeding through into the sort of position you find yourself in with regards to your investments as well. So, perhaps we don't think about joining those dots in our head when we're going about our, social lives or personal lives or home lives at the moment, but it all feeds through.
And very much so, if we think about our portfolios, we have exposure to those trends, both when they're in the US economy, but also when they're in Asia as well, where we have exposure to managers that own some of those Chinese assets as well. So we do have exposure to these broad and potentially very important themes as they're evolving over the next number of years in the portfolio.
Jeff, I remember at the start of the year when we were starting to do the podcasts, there was a few that you and I were on where we were talking about the US-Chinese trade deal, which was a hugely hot topic at the start of the year. And is there any update on that? I know we've had TikTok last week, but there was Huawei before that.
Yeah.
Where are we at with that?
I suppose it's interesting, isn't it? At the start of the year and the fourth quarter of last year, Chinese trade deal was the dominant sort of factor that markets were concerned about. Trump tweeted about what was happening in the discussions. It was an important event. Markets reacted to it, and then you fast forward and we kind of moved on. But it's gradually, I think, as you were alluding to, Peter, it's been coming back onto the agenda over the past probably the past 2 months, I think, where geopolitical risks have started to come back into the discussion. And I suppose why is that? It goes back to one of the points that you're making there, that it's an election. Trump needs to sound off against somebody, and it's pretty convenient to sound off against China at this point in time around it. Where are we with it? Well, the trade deal was around intellectual property, technology transfer, various other aspects. But probably the biggest aspect would have been the agreement by China to purchase quite a significant larger amount of US goods, be that soy, corn, oil, and services. So that there was quite a step up in that. And when we look at how that has worked its way through, given the backdrop, it hasn't been that much. So I think they were to buy an incremental $120 billion worth of US goods and services. It's ticking up, but we're not there yet. So that's something that over the next couple of weeks, I think there was a communique came out a couple of days ago saying that they're going to come together at least and discuss how the phase one is going. and that will, I'm sure, be part of the agenda. It's probably interesting to think about that in the sense of, well, when this deal was agreed, probably that incremental purchases didn't actually mean that much to the overall US economy because it was kind of functioning at record employment levels pretty well. It was working. Whereas now, maybe these Chinese purchases become more important because US growth, global growth is weaker. It could be an interesting dynamic to see how China wants to move forward with that in the coming months and what comes out of some of these discussions that they're having.
Yeah, interesting. For our true potential clients and advisors as well, the last week or so, and if we'll have seen True Insight drop onto doormats, and it's a fascinating read, this edition as well. Lots of great content in there. If you haven't got your copy yet, everybody, it'll be on the way, I'm sure. But with that, I don't want to steal its thunder because it is a fabulous read, and there's a lot of stuff that's really educational and informative and a great insight. But one of the features in there is we look ahead to the next quarter, to what might be coming up and sort of what to watch out for. I'll come to you in a second, George, for your take on that. But Chris, is there anything particularly you're looking out for, looking ahead to the next few months? I'm thinking about the part of the economic outlook section of True Insight. What particularly is jumping out at you at the moment?
Yeah, sure. I mean, I think, the reality is how everything pans out with the coronavirus. That really has been the key mover of everything over the past few months. And the reality is how we get back to some sort of normality, how fast that takes place, what that normality looks like, the potential for maybe a second wave of the virus to come through, how that second wave is dealt with. Is it a sort of local lockdown? Is it a more significant lockdown overall? But for me, that really is the key thing that I'm thinking around. So it's all about people just getting back to normal, consumption getting back to normal, life getting back to normal, all those things that we're sort of waiting for right now. All of those things feed into stock market return, into company earnings. That's really key for me.
Yeah. You didn't mention the B word, so I will. Brexit, of course. Politically, there's not an awful lot going on in terms of, because it's political, it's parliamentary recess, so MPs are all back in their constituencies for the summer. There are still, of course, informal discussions between the UK and the EU, but we'll see how that develops. I think there are two probably bits of sort of things that stick out for me, which is Brexit, as I say, and we'll see what happens. And maybe, George, you've got a view on that, how that might take shape over the next few weeks and months. And then, as I say, this announcement by the Chancellor that we're expecting in September of, I guess, more, whether it's economic stimulus, who knows, but just setting out the general direction of travel on the economy over the next period as well. So there's two things. George, any of that sort of on your radar?
Yeah, I mean, there's all sorts which we're going to be discussing for the rest of 2020, Peter. But I think under three sort of broader headings on the international stage, it will be around trade and trade discussions globally. I think it would be around COVID-19, the recovery, the handling, and where we get in terms of vaccine. And that will brush into how the shape of stimulus as we move forward. So the policy, how central banks aim to continue policy, what shape that will take, but also looking towards the future and looking at debt levels and how they'll be managed and controlled. So I think a lot of things we can put under those broad headings, Peter, but broadly speaking, they're the key things which we'll be discussing.
Jeff, I'll ask the same question to you. Anything else to add?
Maybe I would just add politics and what can happen there. I think the US election, it could be quite fascinating for us. Not because of what typically through an election period, what happens, certain sectors do well, but it's about volatility, and it's probably about trying to stay invested through it is the challenge. What I think could be interesting from a market perspective for the US election is what happens in terms of control of the Senate, control of the House. We know where the Democrats are today in terms of controlling the House. If they could get control of the Senate, well, that would be, an opportunity for, presuming it would be a Democratic president, they could have quite an interesting policy agenda that could come forward. It could be completely the other way, and we could have a situation where Trump is re-elected, with the consequences that could have for the structure of both House and the Senate. So there's quite sort of fascinating things that could be happening there from a policy perspective. And why do you think policy and regulation is interesting? If we go back to last week, we had Jeff Bezos, Mark Zuckerberg, and a couple of other CEOs testifying to Congress about their businesses. And if we think about risk and risks to some of those business models, maybe it is regulatory, and the change in the political landscape in the US could have ramifications for that. So that's something that I think we as market participants have to be aware of, and just how that politics starts to play out over the coming weeks.
Yeah, lots of moving parts certainly over the next few months. Now, I suppose, Chris, just to kind of draw that bit to a close, then I guess diversification is the name of the game always, but it feels to me, I don't know about you, you're obviously much closer to these things. It feels like there's more issues, if you like, at play than ever before than usual. So diversification, definitely the name of the game.
Yeah, absolutely. I mean, I don't think there's ever been what I would describe as a calm time in respect of political risk, stock market risk, economic risk, or however you'd like to call it. But the reality is, there is uncertainty out there right now. We all know it. The fact that we're doing this from home is a kind of key example of that, and how that plays out moving forward is incredibly important. And the key positioning for investors is to be diversified. The reality is no one knows with any certainty what will happen in the future. And the key way to be invested through that is diversified, multi-asset, through a mixture of different assets in different regions, different currencies, and particularly with True Potential. I'm going to give the True Potential portfolios a little bit of a plug, but also with manager diversification as well. That for me is really key moving forward.
Actually, one point I was going to raise, Jeff, earlier was we talked about the UK economy there, we've talked about the US, and even the Chinese as well. We haven't talked about Europe in terms of its economy. How is Europe doing?
Well, I suppose, like other economies at this point in time, the PMI, so the Purchasing Managers Indices, are continuing to trend positively, which is a real positive in the sense of what it means for expectations going forward of economic activity. That has been supportive of the euro. So the euro has done very well over the past number of weeks, and I would argue that's probably come through since May, when they first floated the idea of the European Recovery Fund, and then a couple of weeks ago where that was agreed and moved forward, which it could be quite an important moment for Europe if that continues to show a more cohesive approach to dealing with not just the coronavirus, but also how they think about moving the Eurozone forward in the years to come. So economic activity has picked up. It's probably picked up a little bit faster than people would have expected. And that has been one of the factors that has supported good performance from European assets, and be that European bonds or be it European equities, which have performed very well over the past 2 to 3 months. And indeed, it maybe goes back to one of your earlier points, Peter, of people tend to focus on the big stories in the US, and Europe has kind of gone about its business below the radar screen, but has quite nicely delivered for investors over that period of time.
Yeah, fascinating stuff. Been a really interesting discussion. Thank you, gents, for all of that insight. Just to draw to a close then, because our time is supposed nearly up. The sun's meant to be out this weekend, so are we going to do this Eat Out to help out or not? George, are you going to do it? Are you going to go out?
I'm going out on a bike ride. So if I get back in time and the weather's all right, I might head out, Peter.
Glad to hear it. Jeff, any plans for the weekend for you?
So we are on one of these podcasts before, I talked about going camping with the boys. So I'm taking a few days off next week. So we're going to put the tent up in the garden and camp out with the boys. So that'll be our plans. And we might even head out and eat out as well.
And have you beaten your bike, your time? You're trying to get 16 miles in under an hour, I think you said. Have you done that yet?
I've done it. Yeah, I've done it twice.
Good.
That's it. But it's taken a lot of effort to get myself.
What's your best time then?
Just in below 59 minutes and some seconds. So I've just got in.
Well, I want to hear 55 minutes next time you're on the podcast. There's your challenge. Chris, you were telling us at the start that it's, because you're obviously in London, you were telling us that it's likely to be 36 degrees. Somebody's told you over the next day or so. So you're gonna have to head out somewhere just to douse yourself in water, I think.
Yeah, I think it's supposed to be 36 tomorrow and 34 on Saturday. And I was planning to potentially, this might be an investment management firm theme. I was potentially thinking about going out on my bike as well.
Right. Well, make sure you take a bottle of water with you.
I will get sun cream on the head and stuff like that. Yeah.
Have you done 16 miles in under an hour? Is there a bit of, I detect a bit of competition here?
No, unfortunately, I have to hire a bike. So one of the kind of Boris bikes in London. So to do 16 miles in under an hour on a Boris bike would be some kind of world record. So I think the answer is no.
You'd have to just sort of hook onto a Boris bus and just keep a hold of it. That might be the best way. But fascinating stuff. Thanks very much, gents. And thank you all for tuning in and tuning in and watching the podcast this week. I think it's been a really good discussion. And as we were alluding to just there with Jeff, do have a look on the True Potential YouTube channel. Subscribe to it. You'll keep in touch with all of these podcasts. But as we discussed, there's an awful lot more on there. You can see some of the amazing charitable work that the team at True Potential have been up to and the great causes that benefit from that. You can keep in touch with Jeff, and I think we should pursue this hedgehogging thing. I think we should come back to that, Jeff, at a later date.
We'll come back with a review of the book for you.
And several others as well. I would encourage our audience to watch that video, to pause it on the bookshelf bit and just drop your comments and questions in about other books that Jeff might have that you'd like him to review or just to even explain. But please do share this with your friends and your networks and leave a comment. We'd love to hear that, and we'll address some of those questions and comments you may post on future podcasts. But for now, from Chris, from Jeff, from George, and from me, it's bye for now.